Sorry girls, there was a problem, so the video got cut. I'm continuing with the spacing out direct credit programs. That is, since nationalization, government had adopted various policies, okay, and principles, and even for the commercial banks, they had given some rules and regulations. Like for example, they told for all the needy and the poor people, you are supposed to provide loans at concessional rates. Okay, that is, the loans were given at a reduced rate of interest. Say for example, in common, if it is going to be 15% interest that which is charged for a loan given by commercial banks, government forced these banks to provide at concessional rates. Only 10% rate of interest can be charged for the needy people, the poor people and rural areas. So this means what? For that 5% loss, the profits of the commercial banks were reduced. So, Narasimham committee came up with another recommendation stating these kind of credit programs should be stopped. Okay, there shouldn't be any kind of concessions given for poor or needy people because the commercial banks were under loss because of these kind of schemes of government. So that was the second recommendation, that is to stop such kind of programs. The next one is interest rate determination. Okay, so what is this interest rate determination? So you all know that whenever the commercial bank provided loans, okay, to the general public, they were charging interest because interest is the main source of income for commercial banks, isn't it? And this interest rate was fixed by whom? It was either fixed by Reserve Bank of India or Government of India earlier. So, what was the recommendation about this interest rate determination is the committee told let the interest rate not be determined by Reserve Bank of India or Government of India, but rather let it be determined by the market. Okay, market means market takes into consideration the demand and supply. Okay, so based on demand and supply, let them fix the interest rate. If the demand is more and the supply is lesser, that means the rate of interest will be high. If the demand is less and the supply is more, means the rate of interest will be low. Do you understand? So based on this market condition, let them fix the rate of interest and let it not be fixed by Reserve Bank of India or Government of India. So that was the another recommendation on interest rate. The next one is structural reorganization of the banking sector. Okay, that is the committee also recommended, okay, for the structural reorganization. That is, many banks were nationalized, I told you earlier, but nationalization means being under the control of government, and that was making many of the banks, not having enough freedom, or rather, not making enough profits, in not having enough freedom in making their own decisions, in modernizing their businesses and all that. There were a lot of interruptions by the government. At the same time, the profits were also less. So they wanted the public sector banks to be converted into private sector. Okay, so today many private sectors are only very profitable than government sectors, isn't it? Because in government sector the rates of interest and everything will be lower. If you compare also nationalized banks with private sector banks will charge more of interest, but the nationalized banks will charge less rate of interest. Their profit motive is lesser when compared to that of private sector banks. So they wanted to convert public sector to private sector so that profit earning becomes more. And not only that, they wanted to convert the nationalized banks to international banks. Okay, so that kind of structural reorganization they recommended, okay, for the banking sector nationwide. The next one is establishment of asset reconstruction fund tribunal. So what is this recommendation all about? This is basically a fund which has to be established by the banks in order to overcome their non-performing assets and bad debts. Okay, have you all heard of what is bad debts? Bad debts are those debts that which you will not be able to recover. Okay, say for example, you have given a loan for someone, but that loan is not going to come back to you. You are very sure. Okay, that loan will not be returned back. Now that will become a bad debt for you, and those bad debts are definitely losses. Okay, and apart from that, non-performing assets, there are certain assets which will not give you any income. Okay, as far as the banks are concerned, there are certain assets which never gives them any income or gives them zero income, and maintenance of those assets becomes a problem for the banks. So they wanted to come up with an asset reconstruction fund, meaning this is a scheme where they were going to they were asked to maintain a fund, okay, like a small investment, like in order to overcome these bad debts. So when they know that there is a bad debt, then there is a non-performing asset, so to overcome this situation they will have a particular fund which is built from time to time, and that fund can be utilized to overcome these bad debts. Just like how your corporates, your companies, your business organizations will have reserves. So when they maintain this reserve in case of difficulty, losses and all that, they'll utilize these reserves to overcome those losses. So similarly, here also, asset reconstruction fund is something like a reserve which is kept aside by the banks, which is maintained by the banks in order to overcome their problems of bad debts and non-performing assets. So that was also recommended, okay, to get rid of the bad debts and non-performing assets. The next one is removal of dual control. The next recommendation which was made by the committee was they wanted to remove the dual control. There shouldn't be two people controlling, okay, rather there's only be one person controlling, or one organization controlling, one authority controlling. So who are the two authorities who are controlling banks? So one is your government of India, the other one is the Reserve Bank of India. Alright, so they wanted to remove this dual control. They told, okay, both the authorities cannot control. There will be a lot of clashes, there will be a lot of chaoses, differences in opinions, okay. Of course, Reserve Bank of India acts on behalf of government, but sometimes when government is also there, it becomes a difficult task. So therefore, what they told is, let only Reserve Bank of India govern the banks and not the government of India. Okay, so that was also recommended. The next one is banking autonomy. Autonomy, have you all heard of autonomous? So autonomous means what? Self-governance. Okay, so even in colleges, if you take into consideration, our college is under Bangalore University. Okay, but there are also certain other institutions which are not under Bangalore University or any university for that matter. They have their own university, their own rules and regulations, their own self-governance. That is what is called as autonomy. So they also wanted to provide autonomous, okay, for many banks, so that they will be free from the clutches of be it government or Reserve Bank of India. Okay, so that was also recommended. They wanted to free the banks, okay, and recommended many public sector banks to be free and autonomous. Alright, so that they can be more competitive and they can be more efficient and enjoy their self-governance. Okay, so that was another recommendations. Alright, so these were the recommendations that which was made by Narasimham Committee Report 1. Alright girls, so we'll move on to the next report. Like I told you, this was set up in the year 1997 and the report came into existence in the year 1998. And this is called as Narasimham Committee Report 2, which was led under the able guidance of Mr. Narasimham. Alright, and this was recommended by Chidambaram, Finance Minister then. Alright, so let's see what were the reformations that which were brought forth by Narasimham Committee Report 2. So first one is strengthening the banks in India. Okay, then after all these reformations of Committee 1, okay, so few of them were executed and the banking sector was little improved. Now some more improvements were needed, for which they came up with the second committee, and that one first recommended strengthening the banks in India. So what do you mean by strengthening? So you all already you would have heard of this one story called, if one is weakness, together is strength. Isn't it? Being alone is weak and being together is strength, isn't it? So similarly here what they did is they wanted weak banks, okay, all the weak banks to come together and form one bank. So you would have heard of something called as mergers and acquisitions, isn't it? So they recommended mergers and acquisitions of few banks, wherein few weaker banks were asked to merge together. So 4 or 5 banks, weak banks, smaller banks were asked to merge together and make one bank. Similarly, bigger banks, okay, nationalized banks were asked to absorb or rather acquire smaller banks and join them with them. So that was what was the strengthening of the banks in India, mergers and acquisitions. So which was done on the current account convertibility basis. Okay, so where they were given the freedom to convert their functioning from their private sector to the public sector, or from rupees to dollars, so like this. So basically this particular point all about is you can avoid other things and just give the explanation as mergers and acquisitions were allowed. Okay, so many banks together became one bank. All right, the next one is narrow banking. So what is this narrow banking? So those days, many banks were facing a lot of problems, especially with non-performing assets. And I also told you about the bad debts and all that, isn't it? So they were in the urge of becoming sick. All right. So they were almost in the urge of becoming a sick bank. And when they become a sick bank, they'll come to the extent of being closed down and all that. So to avoid such things and to rehabilitate such banks, again certain recommendations were made, and that one among them is the narrow banking structure. So what does this narrow banking structure means? So this is a concept where weak banks were allowed to invest their funds only in short term and risk free assets. Okay, not in long term, because when they are investing in long term assets, what happens is their investments sometimes will not give them good returns, and it will become a dead investment. So instead what they did is they wanted to come up with this particular recommendation, wherein these weak banks, okay, with problems, okay, of bad debts and non-performing assets, can be allowed only to invest in short-term and risk-free assets. They were not allowed to also invest in assets which were very risky. Okay, that will put them more in a difficult state, or rather in a state where they will get into more losses. So to recover and rehabilitate such banks, they allowed them only to invest in short-term. Short-term means less than 1 year financial investments, and risk-free means to evade risk. Alright, the next one is the capital adequacy ratio. Okay, so what is this capital adequacy ratio? Again, in order to strengthen the banks in the India, the committee came up with this capital adequacy norms. Okay, so this is a norm, or this is a ratio of a bank's capital towards risk. That is, it is to say that how much of the capital is exposed to risk, or how much of risk is exposed to the capital. All right. So basically, to reduce the risk exposure to the capital only is nothing but capital adequacy ratio. Alright, so like I spoke about narrow banking, isn't it? So narrow banking, I told you that they were allowed to only invest in risk-free assets. So similarly, even in capital adequacy ratio, what happened was their exposure to risk was reduced. Okay, the exposure of especially banks' capital to risk was reduced, so that they will be more strengthened, and they will not have lot of uncertainty that which they are facing, and this will enable in the improvement of their performance or productivity. So that is about the capital adequacy ratio. Next one is the bank's ownership. Okay, so I already spoke about banks ownership in committee 1, isn't it? So committee 2 also is making similar recommendations, where the more of banks should be allowed to become autonomous. I told what is autonomous. Autonomous means self-governance. Now removing them from the clutches of the government and Reserve Bank of India, and allowing them to govern themselves, and giving them the freedom, okay, to be more competent and efficient. So that was recommended for more number of banks. Already few banks in the report 1 were converted into autonomous institutions. So now more banks were recommended for the autonomous conversion. Okay, and also to reduce the control of the government was also something which was initiated and reviewed. The next one was review of the banking laws. So the committee also made it necessary for reviewing the laws, and they also came up with amendments. That is, see, rule and regulation that which is made once upon a time cannot be put in practice for a longer period of time, because of the changes in the situation, circumstance, the environment, okay, of the bank, okay, the changing trends in the world. Even the rules and regulations should be changed, isn't it? So they also recommended to review the banking laws. Okay, review means to again look into the rules and regulations and to come up with amendments. Amendments means changes, not to completely change the rule and regulation, but to come up with some kind of improvements. Okay, some slight changes in the rules and regulations in order to cater to the current demands and needs. They wanted to upgrade the rules and regulations, okay, in order to match the present needs of the banking sector in India. So this was the last recommendation which was made by your Narasimham committee report 2. Alright, so now to conclude with this topic, okay, so we will let's evaluate both the committees. So they brought up a lot of recommendations, isn't it? We have seen the various recommendations that which was brought forth by the committee. Now if you evaluate committee 1, okay, of course, if you evaluate committee 1, few of the recommendations were accepted by Reserve Bank of India and Government of India, and they were put into practice, they were implemented, and few others were not at all considered. Okay, so that was when they came up with the second committee, okay, in 1998. So at that time they again pressurized on few of the recommendations of that which was made by committee 1 itself, and they also came up with some more newer recommendations, and then they tried to strengthen the entire banking sector, and they saw also that these reformations were put into implementation. Okay, so this is the evaluation. Whatever was left behind by committee 1 was taken seriously by committee 2, and they tried to implement such kind of recommendations that which was made. Alright girls, so with this topic our syllabus has come to, our third chapter syllabus has come to an end. Alright, so if you have any doubts you all can ask me. If you want me to repeat any points also, I will do it for you. Please listen to the video carefully and understand the topic properly. Alright, thank you.